Hello everyone, it's your finance advisor girl Omomi, and today I'll be sharing best investment options for your RRSP. Best investment options for your RRSP. To maximize your RRSP, choosing the right investment is crucial. Your selection should align with your risk tolerance, time horizon, and retirement goals. Here's a breakdown of the best investment options for your RRSP. Number 1, growth-oriented investments for long-term strategy. Growth-oriented investments for long-term strategies. If you have over 10 years before retirement, prioritize growth investments to maximize compounding returns. This can include stocks and equity-based ETFs, mutual funds, and index funds. Stocks and equity-based ETFs are ideal for higher returns over the long term, but they have short-term volatility. RRSPs shelter investments from capital gains taxes, so growth stocks and ETFs can compound tax-free. Examples include blue chip stocks like Canadian banks, energy and tech companies, dividend stocks that generate income and reinvest for growth, and broad market ETFs. Look for dividend reinvestment plans to compound growth within your RRSP. For mutual funds and index funds, these are ideal for investors who prefer a hands-off, diversified approach. They have professional management and they can provide steady long-term growth. Examples include equity mutual funds that are actively managed by fund managers and low-fee index funds. Watch out though for high management fees that can eat into your returns. Number 2, income generating investments for stability and preservation. Income generating investments for stability and preservation. As retirement nears, maybe within 5 or 10 years away, you shift towards lower risk income generating investment. This can include bonds and bond ETFs, like government bonds, corporate bonds, and so on. These are ideal for stable returns and capital preservation. They are less volatile than stocks and they provide steady income. Government bonds are secure, but they have lower returns. Corporate bonds have higher returns, but with slightly more risk. And bond ETFs have diversified exposure to different bonds markets. Use a mix of short and long-term bonds to balance risk and return. Another example is guaranteed investment certificates, and these are ideal for safe, predictable returns for near-term retirement savings. Your principal and interest are guaranteed and there is no market risk. There is fixed rate GICs that lock in returns over time, and you have laddered GICs that can stagger maturity dates to optimize interest rates. GICs are best for conservative investors who have lower returns rather. They are best for conservative investors but have lower returns than stocks and ETFs. 3, alternative investments for diversification and inflation protection. Alternative investments for diversification and inflation protection. To add stability and hedge against inflation, consider alternative assets in your RRSP. This can include real estate investment trusts. They are ideal for real estate exposure without the burden of owning and maintaining a property. It provides rental income and capital appreciation. For Canadian real estate investment trusts, you can invest in shopping centers, apartments, and office buildings without owning these properties. And you can also have the Global Real Estate Investment Trust that provides exposure to international real estate markets. Also, there are commodities like gold, silver, and oil ETFs. This hedge against inflation and market downturn protection. Commodities can retain value during stock market declines. They hedge against inflation and current risks, and the energy ETFs provide exposure to oil and gas sectors. Last but not the least, RRSP investment strategies based on age and risk tolerance. Ideally, your investment mix should evolve over time. For example, if you are between 20 and 30, you are usually high risk. You should be a high risk taker, so you can have 80% of your investments in stocks and ETFs, 10% in bonds, and 10% in alternatives, because you have time before you and you can use it to your advantage. If you are in your 40s going to 50s, then you are at moderate risk level. So you should have 60% of stocks, 25% bonds, and 50% alternatives. If you are 60 and above, or you are close to retirement, then you are a low risk. So you should have 30% stocks, 50% bonds, and 20% GICs or income funds. Final tips: ensure you diversify. Have a mix of stocks, bonds, and income generating assets to balance risk and return in your RRSP portfolio. 2. Reinvest dividends. Use dividend reinvestment plans for compounding growth. 3. Rebalance annually. Every year, adjust your portfolio, review it, adjust it, and allocate appropriately as retirement draws close. Then 4. Minimize high fees. Prefer low ETFs and index funds over expensive mutual funds. Then lastly, consider a financial advisor. Professional guidance can optimize tax efficiency and returns. Do you have any questions or need more clarity? Drop them in the comment section below, or better still, send me an email at pennywise071213@gmail.com. That's pennywise071213@gmail.com. I'd love to help. If you found this video helpful, don't forget to like, consider subscribing, hit the notification bell so you don't miss out on any of my video uploads, and share this with someone who needs to start investing for their future or preparing for retirement. Let's build your wealth together. See you next week in my next video by God's grace. Bye bye.